Hello everyone, this is Thomas with Algo Trader's Edge, and today we're going to go into a little bit of an overview of the different systems available on the ATE website. Before we get started, you need to go through the risk disclaimer. Just keep in mind, past performance is not necessarily indicative of future results, and this presentation does not constitute an offer or solicitation of an offer for the purchase or sale of any securities. There is also risk, substantial risk, when trading markets. Now with that being said, let's talk a little bit about what the LOD model is and how it works. So with Algo Trader's Edge, you have the ability to put money in your account and then have automated trading strategies executed on that account for you by paying a monthly, quarterly, or annual fee. Now, some of the advantages of doing this with LOD as opposed to the traditional model of going through a CTA or a hedge fund is we have daily liquidity. There's no lockup periods. We also offer discounts on a quarterly or annual basis in order to have the systems executed on your trading account. And it also gives you diversification from a classic portfolio of just stocks and bonds and ETFs. You can get into the futures market and have quantitative automated systems trading to offer that additional diversification. Now let me tell you a little bit more about the investment strategy and how this works. So it's quantitative, systematic, algo-driven trading strategies. We have time horizon diversification effects. So we have some systems that are looking for long-term trades, some that are looking for short-term trades, where we might have one trade that stays on for 6 months at a time, catching a long-term swing in the stock market. We could simultaneously be going long and short intraday on a very short time frame basis, trading within the context of that overall long position. So we have long and long short systems, which gives us the ability to potentially profit in any economic or market environment, which we'll talk about more in a little bit here, just in a few minutes. You also our goal with this is to minimize account volatility while maximizing our returns using leverage. So this is an example of the volatility of the ATE Diversified portfolio for a $100,000 account versus the S&P 500. You can see the blue line here is the equity curve of the diversified portfolio, and you can see it's very, very consistent with minimal drawdowns and minimal volatility due to the diversification. Whereas this gray line is the S&P 500 and how that's moved going through bear markets like 2008 and again here recently like we've seen in 2020. And all the while, the systems are staying very consistent, making money both in the long term and the short term. Now let me tell you a little bit more about how the systems work. So our systems use advanced algorithms to determine market bias. We have different strategies for entering in trend following, mean reversion, breakout, and based on market sentiment. We use pattern recognition and machine learning in determining the ideal entry, stop, target, and trade management. Now, our proprietary models and trading technology support all of our trading strategies. So this is not available anywhere else. These are proprietary to us. Systems adapt to changing market environments. Our systems adapt to changing volatility. We have the ability to simultaneously go long and short in very correlated markets. For example, we can be long the NASDAQ and short the S&P, or vice versa, long the S&P and short the NASDAQ, or short the Russell and long the S&P, or long the S&P and long gold simultaneously. So we can trade correlated markets and hedge ourselves and lower that volatility and decrease our risk so that if one strategy is underperforming, another strategy should be overperforming and help keep that consistency because of that diversification. Now, our systems use long-term trend following in addition to short-term and intermediate-term long and short signals. So we do have some long-term strategies that are, for example, with the S&P, where we'll get in long and build a position over time, and it may hold that strategy, that position, for months at a time as long as the market continues to trend up. And then, like I was saying earlier, it will simultaneously be trading long and short in shorter time frames within the context of that overall bullish position. Now, this allows us to take advantage of long-term overall upward trends of the markets while simultaneously trading inside of the short-term volatility to maximize gains and minimize the drawdowns. Now, we achieve this lower volatility by diversifying systems across both positively and negatively correlated asset classes, including the S&P 500, the NASDAQ 100 index, the Russell 2000 index, and gold futures. So we're trading 3 different indexes, large cap, small cap, or large cap, mid cap, and then also gold to offer a little bit more diversification. And we're all trading in the futures markets. Now, each trade, it's constructed using the following 6 parts. It has market bias, it adjusts for volatility, it signals an entry, it places a stop, it places a target, and then it manages the position once we've entered. And one of the goals that we have with this is to cut off the losing trades quickly while allowing the winning trades to run and make much more on an average winning trade than what we lose on an average losing trade. This is an example here of one of the gold systems. You can see we had a long here, and then it covered very quickly for a loss, but then we had a long here where it allowed it to run much larger, and then again here, a long allowed it to run much further and catch these nice big swings while simultaneously trading within the context of that system's bias. All right, now along those same lines, here's another example. This is the NASDAQ, and this is one of the strategies trading in the NASDAQ. And you can see we had a long strategy where it gets in, holds onto the trade for quite a while, and then exits. And then immediately after that, we tried getting long again, and it quickly cut it off. And then once more, it had another long signal trade over here and allowed it to run quite a bit all the way up to the upside and catch a nice big move once more. So once more, the goal with this is to allow the winning trades to stay in for a much longer period of time or for a much larger percentage move while simultaneously cutting off those losing trades as fast as we can to minimize the risk. Now let's talk about risk management and how this works. So there's a couple different things we've done with the systems available at ATE. We have portfolio risk management. So every single strategy, every single trade we take has a maximum stop loss, so that we're not going to come in and have the market just move against us and move against us and move against us. There is that uncle point where it says, okay, enough is enough and time to get out of the trade. So every trade has a stop loss. And then we have the ability to start with smaller positions and then build into a larger trade. So we can start off with a very small position, and as the market continues to move, we can add to it and then add to it again for a maximum of 3 times and build a much larger trade. Here's an example of that. This is the S&P strategy. And you can see here, it started off buying and then bought again the next week and then bought again a couple weeks later. So we built into a 3 contract position and wrote it all the way up here. Same thing here, started one, added another, and then added another and wrote it up. Same thing here. It started off with 1 contract, it got stopped out, but then it built a new position here, wrote it up, and same thing here, 1, 2, 3, building into the position over a 3-week period and wrote it all the way up for a nice big winner at the beginning of 2020. So that is how we do it. Now let me tell you a little bit more about the performance for these systems overall. Overall, this is back-tested performance, obviously, so there's no guarantee that's going to happen again in the future. This is the equity curve and the total profit over the past 15 years or so in the ATE Diversified portfolio for a $100,000 investment. We're averaging about a 47.4% annual return, with an average annual profit of $47,408 before fees. It has a win rate of about 53.7%, and our return to drawdown ratio is 40.3. Our average monthly profit is right around or just under $4,000 per month for every $100,000 unit that you have with this portfolio. Now our maximum drawdown is 18.06%. So there is more volatility, and you have to understand this is a long-term portfolio and we are using leverage. So in order to achieve these very high number returns, these higher percent returns, there is going to be more volatility, and you will have larger drawdowns like 18%. But again, the overall return should greatly offset that throughout over time. Now, here's an example of the monthly performance over the past 15 years or so. And you can see in 2020, we've done very, very well. January, we were up 31,270. February, we're up 4,000. March, up 1,600. And April so far, we're up 6,758. So doing really well this year. Already year to date, we're up 43,000, and it's only April. And this is one of the worst years for most traders out there, where many people are losing money because the market's collapsed due to CV-19. But instead of having the systems go into a drawdown, they've actually outperformed greatly, which is exactly what we're after by using automated strategies that trade these types of markets, trade futures, long-term and short-term like this. So if you want to learn more or sign up and get started, all you have to do is go to algotradersedge.com. We have systems available for $5,000 accounts, $10,000 accounts, and $100,000 accounts. At the moment, all you have to do is fill out your information, and we will contact you and tell you how you can get started with trading with ATE. That's it for today. And until next time, everyone, happy trading.